The 42 trillion question isn't about debt ceiling politics. It's about your savings account. 36 trillion and climbing, a debt mountain our government cannot pay. They have a secret three-part playbook to make that debt irrelevant, and it turns the very system you trust, your bank, into a weapon against you. You are watching the greatest wealth transfer in history begin. Don't be the fuel. The 42 trillion question, the silent theft of American savings. Debt. That is the 42 trillion question facing every American today. You are watching the US national debt clock tick past 36 trillion in real time, but that's just the visible tip of an ice-cold iceberg. Projections, our own government's projections, say we hit 42 trillion by 2027. This isn't just a number, it's an economic black hole, and the gravitational pull is already bending reality. Our debt to GDP ratio has exploded past 123%. That is a level not seen since the furnaces of World War II were burning across the globe. You need to understand the implications of that number. It signals a crisis so profound, our government cannot, will not pay this debt back. They have a hidden playbook, a three-part machine designed to make this mountain of debt utterly irrelevant. The first two parts are about manipulating interest rates and unleashing the printing press. You've seen whispers of it in the news. But the third part? That's the most dangerous. It turns your own bank, your own financial institutions against you. It weaponizes the system you trust to keep your money safe. And I'm going to show you exactly how they do it, not in some theoretical future, but right now. Your savings, your retirement, your future, they are about to become the fuel for this unprecedented wealth transfer. Historically, periods of high debt have often been managed through what economists term financial repression. This isn't a new concept. It's a reoccurring feature, a feature that was perfected right here in America after World War II. Picture this: February 1946. The United States owed $269 billion, an astonishing 119% of our entire economy. By 1960, that nominal number had barely budged, just $286 billion. But here's the magic trick. The debt to GDP ratio plummeted to a mere 55%. Our government didn't pay back a single dollar. They did something far more elegant. They made the debt irrelevant. What does financial repression truly mean? It's not a default. It's not outright confiscation. It's far more insidious. Imagine you lend your neighbor $100,000 at a fixed 2% interest. Sounds like a safe deal, right? Now imagine your neighbor's income suddenly doubles, but the dollar loses half its purchasing power. When they finally pay you back that $100,000, it only buys what $50,000 would have bought when you first lent it. You've been paid back, yes, but your neighbor cut their real debt burden in half. You paid the price. That is financial repression, a systematic, often imperceptible, transfer of wealth from savers to the government through negative real interest rates. Now, the critics will immediately jump up and say, "But Jordan, that was wartime, an emergency, a one-time measure." They would be wrong. This wasn't a bug in the system. It was, and still is, a foundational feature. The infrastructure built then became the template. Federal Reserve cooperation, interest rate manipulation, captive domestic buyers through banking regulations, rules that force institutions to hold treasuries, and systematic currency devaluation through inflation. The government doesn't need to pay back debt in any meaningful sense. It only needs to manage the debt to GDP ratio, and they manage it by bleeding your savings dry. Some economists today point to something called modern monetary theory, or MMT, as if it's a radical new philosophy. But make no mistake, MMT is less a new theory and more an upgrade to this long-standing playbook of financial repression. It's the sophisticated, academic-sounding justification for simply printing money and inflating away debt, disguised as a tool for full employment or economic stimulus. It's not new. It's just a slicker way to describe the same old shell game. So where are we today? Our national debt is soaring past $36 trillion, climbing rapidly towards that projected $42 trillion. Our debt-to-GDP ratio is back above 120%, and our interest costs? They are approaching $1 trillion annually. On your screen, look at the projection for interest costs for 2025, $1.14 trillion. That's more than we spend on national defense. The math has become impossible, and when the math becomes impossible, the government doesn't change the math. They change the dollars. They change the value of your dollar. We've already seen the signals. When the Fed recently signaled a definitive pivot towards accommodation, it was a flashing red light. And the Treasury's massive refunding needs this year, hundreds of billions in new borrowing, made it undeniable. The message from the highest levels of power couldn't be clearer. Treasury funding needs now supersede inflation control. The Fed's so-called independence lasted exactly as long as the debt stayed manageable. At $36 trillion, we've crossed the event horizon. Positive real interest rates would literally consume the entire federal budget. It is too late. The infrastructure is already in place. New regulations like Basel III and the supplementary leverage ratio exemption essentially force banks to become captive buyers for government debt, regardless of the returns they're getting. Your pension funds, your insurance companies, they are all being steered, even forced, into buying treasuries. And the Treasury Department, they are extending the average maturity of our debt, locking in these artificially low rates for longer. Every piece of the machine is in position. Now, what could stop this? Some might argue that hyperinflation or a bond strike could derail this plan, but that would imply a complete breakdown of confidence, something the government will fight tooth and nail to prevent, even at the expense of your wealth. And the architecture for prevention is already robust. They have designed a system to ensure that, short of outright collapse, the funds will flow. This isn't a flaw, it's the design. So, who loses when the reset fully activates? You do. The bondholders, the savers, anyone holding cash or fixed income investments. Your wealth gets systematically transferred to the government through negative real yields. There's $10 trillion in US Treasury bonds held by the public right now. At just negative 2% real rates, that's $200 billion in real wealth loss annually. Think about that. And for the 46 million Americans over 65 who depend on bond portfolios and fixed income for retirement, their living standards will decline. Their hard-earned savings will melt away, not in a bank heist, but in plain sight, sanctioned by law. But for every loser, there are winners. The federal government, of course. They could compress that debt to GDP from 123% back down to 75% over the next 10 to 15 years with this strategy. That's wiping out over $13 trillion in real debt burden without a single principal payment. And then there are the strategically positioned citizens. Hard asset owners, people who own real estate, commodities, certain equities with strong balance sheets and low debt-to-equity ratios, they will see their nominal values rise with inflation. If you bought a house in 2010 for $200,000 that's now worth $500,000, you've already experienced this mechanism at work. Debtors with fixed-rate loans, mortgages, student loans find their payments becoming easier to service as wages inflate, but payment amounts stay fixed. And for those truly proactive, vehicles like Treasury inflation-protected securities or even diversifying into select foreign real estate markets could offer a hedge against this domestic wealth transfer. The true enemy here is not malice, but simply unsustainable math. met with an institutional response that prioritizes government solvency over the purchasing power of your money. It's the silent erosion orchestrated by the architects of our financial system. You might think this is a conspiracy. It's not. It's history. Let's go back to 1946, the last time our debt was this high, and I'll show you the blueprint for the crime. The original sin, America's post-war heist. Debt, 119% of our entire economy, just after World War II. I'm Jordan Blake. I've spent over 10 years researching the mechanics of financial crises and market bubbles, and what I'm seeing today in our national debt is a pattern I haven't seen since the post-war era, a pattern that impacts your money. I'm going to be walking you through exactly how this situation impacts your money, and it starts with a secret history, the original sin of American finance. Look at this chart. In February 1946, the United States owed $269 billion. That was a staggering 119% of our entire economy, a crushing, unsustainable burden after fighting the costliest war in human history. Yet, just 9 years later, by 1955, that debt-to-GDP ratio had plummeted to 71%. And here's the kicker, the part they don't teach you in economics textbooks. The nominal debt level barely changed. It actually rose slightly to $286 billion by 1960. So how did they pull off this magic trick? How did nearly half our national debt simply vanish without the government paying back a single dollar? This wasn't fiscal prudence. This was a sophisticated heist orchestrated against the very citizens who bought those war bonds. The architects of this plan, Fed Chairman Mariner Eccles and Treasury Secretary Henry Morgenthau Jr., weren't discussing military strategy in April 1942. They were engineering what I call the original sin, a financial magic trick designed to quietly transfer hundreds of billions of dollars from everyday Americans to the government. They struck a deal. The Federal Reserve would cap Treasury bond yields at a paltry 2.5% for the duration of the war and beyond. Sounds technical? Here's what it meant for you, the patriotic American saver. Between March 1942 and March 1951, during this same period, average annual inflation was raging at 5.7%. Do the math with me. Your real interest rate, what you actually earned after inflation, was negative 3.2% for nearly a decade. Think about that. Every single bondholder, every citizen who lent their hard-earned money to the government was guaranteed to lose purchasing power year after year after year. You lend the government $100. They pay you back in dollars that only buy what 97 would have bought when you started. It was called patriotism. It was called supporting our troops. What it wasn't called was its real name, financial repression, the government's secret weapon for eliminating debt without default. This wasn't an accident. This was a deliberate, systematic policy, and the impact was staggering. As economists Carmen Reinhart and M. Sprancia detailed in their 2015 IMF working paper, The Liquidation of Government Debt, they estimated a staggering wealth transfer of $800 billion in 1980 dollars from savers directly to the government. In today's money, that's nearly $3 trillion, quietly extracted from the pockets of trusting Americans over decades. They told you it was patriotism. They told you it was supporting the war effort. What they didn't tell you was that they were systematically liquidating your savings, turning your hard-earned dollars into cannon fodder for their debt. It's like lending your neighbor $100,000 on a 2% annual loan. Sounds manageable, right? But then, imagine his income doubles over the next decade, while the dollar loses half its purchasing power. When he finally pays you back, that $100,000 principal only buys what $50,000 would have bought when you first lent it. He cut his real debt in half without sacrificing anything. You, the trusting neighbor, paid the price. That's exactly what our government did from 1946 to 1960. American citizens, banks, insurance companies, pension funds, they were the neighbors who got paid back in devalued dollars. Now, the cheerleaders for big government will argue, but Jordan, that was wartime, an emergency measure, a one-time thing. And they'd be right about the context, but they'd be dead wrong about it being a one-time event. Because this wasn't a bug in the system, it was a feature, a playbook perfected and waiting to be deployed again and again. The infrastructure built in the 1940s became the blueprint for systematic currency devaluation, interest rate manipulation, and creating captive domestic buyers through banking regulations. It's a trick so elegant, most Americans still have no idea it happened. The government doesn't need to pay back debt in any meaningful sense. It just needs to manage the debt to GDP ratio. It's almost as if they're following an early, unwritten version of what some now call modern monetary theory, though far more insidious. Instead of outright printing, it's a silent theft of purchasing power. The playbook is brutally simple. Suppress real interest rates below the rate of economic growth, especially inflation-driven growth. Let nominal GDP expand faster than debt levels and watch the ratio compress. And who pays? You do. Bondholders, savers, anyone holding cash or fixed income investments. Their wealth gets systematically transferred to the government through these negative real yields. So who wins in this scenario, this quiet war on your savings? The winners are clear. Our federal government, which can compress its debt to GDP ratio without a single principal payment, and hard asset owners. I'm talking real estate, commodities, infrastructure, equities with low debt-to-equity ratios, even specific assets like Treasury inflation-protected securities, TIPS, if you know how to navigate them. Debtors with fixed-rate loans see their payments shrink in real terms as wages inflate, but payment amounts stay fixed. But for every winner, there's a massive loser. That's you, the saver, the bondholder, the retiree dependent on fixed income, anyone holding cash. Their wealth gets systematically destroyed, transferred from the private sector to the government, from people who trusted in fixed returns to an institution that could simply change the rules. Now, the government isn't impervious to the consequences. Push this too far, and you risk a bond strike or hyperinflation. But they've built the machine to try and prevent that. The legal framework is not just in place, it's operational. New regulations, like Basel III capital requirements, essentially force banks to become captive buyers for government debt, regardless of the returns they're getting. The Treasury Department has proactively extended the average maturity of our debt, locking in these lower rates for longer periods. This isn't free market operation. This is a system designed to funnel your money into government coffers at below market rates. They pulled off the greatest wealth transfer in history, and it worked perfectly. But they needed to refine the tools to do it again without the excuse of a war. That's what happened in 1971, when a single TV announcement turned the US dollar into a weapon against its own people. Nixon's confession, the dollar's death warrant. 1971, a Sunday night, 9 p.m. Eastern. President Richard Nixon appears on your television screen. His announcement, delivered with a calm gravity, would fundamentally, irrevocably reshape the entire global financial system. He declared the United States was suspending the dollar's convertibility to gold at $35 an ounce. The Bretton Woods system, the foundation of global finance since 1944, died in a single televised address. You need to understand the gravity of that moment. Before Nixon, foreign governments could exchange their dollars for a fixed amount of physical gold. This meant our government, the Federal Reserve, had to maintain some semblance of fiscal discipline. There was a tether, a physical limit, a constraint on how much currency they could conjure out of thin air. When Nixon severed that final link, he didn't just change a policy. He ignited the fuse on an economic bomb. He removed the last vestige of discipline. The printing press, ladies and gentlemen, had no limits. And the market, as it always does, revealed the truth almost immediately. Within 2 years, gold, once fixed at $35 an ounce, was trading at $120 an ounce. That's a 240% increase in just 24 months, a flashing red light screaming the dollar's instant devaluation. What happened next was not accidental. It was by design. With the gold anchor gone, the government possessed an unlimited printing press. You want proof? Look at this chart right here. This is the M2 money supply, basically all the dollars circulating in our economy, plus savings accounts. In 1971, when Nixon pulled the trigger, it stood at $685 billion. A decade later, by 1981, that number had exploded to $1.6 trillion. That's a staggering 133% increase in your money supply in just 10 years. Think about that. More than double the dollars, chasing the same amount of goods and services. It doesn't take an economics degree to know what that means. It means inflation. It means your purchasing power, your hard-earned wealth, evaporating before your very eyes. From 1973 to 1981, inflation averaged an agonizing 8.8% annually. Let me put that in brutal, simple terms. $1 in 1971 bought you roughly 35 cents worth of goods by 1981. That's not just a statistic. That's a family struggling to fill their grocery cart. That's a retiree watching their life savings shrink into irrelevance. That's a direct wealth transfer from you to the government. The villain here? Inflation. The enabler? A Federal Reserve that, under Chairman Arthur Burns from 1970 to 1978, explicitly accommodated Treasury borrowing needs. The Fed's independence? A polite fiction, even back then. But the silent theft didn't stop there. This is where financial repression, the government's secret weapon, truly shines. They need you to think you're still making money even as they devalue it. Look at this next chart. From 1973 to 1980, Federal Reserve data shows average 10-year Treasury yields were 7.8%. Sounds pretty good, right? You're earning nearly 8% on your government bonds, a safe investment. The truth? Inflation during that exact same period was averaging 9.2%. Do the math. Your real yield, what you were actually earning after inflation, was a crushing negative 1.4%. You thought you were earning money. You thought you were being smart. But every single year, your purchasing power was systematically eroded. You were losing money. The government was paying you back in cheaper dollars thanks to their unlimited printing press. And to ensure you couldn't escape this trap, they had a legal ironclad cage in place. Enter Regulation Q. This obscure banking act, introduced in 1933, allowed the Federal Reserve to set maximum interest rates that banks could pay on your savings accounts. For decades, banks were forbidden by law from offering you market rates. They couldn't compete for your deposits. They couldn't give you a fair return. By 1980, the situation had become absolutely criminal. Passbook savings accounts, your local bank, legally capped at 5.25%. Meanwhile, official government inflation hit a staggering 13.5%. Think about that. You were legally guaranteed to lose 8.25% of your wealth annually for every dollar sitting in your savings account. This wasn't a mistake. This was a deliberate, institutionalized wealth transfer. A guaranteed loss for every American saver, funneling your capital, your future, your security directly into the hands of a government eager to finance its spiraling debt. Now, some might try to rationalize this away, claiming these were merely emergency measures, unavoidable in a turbulent era. They are fundamentally mistaken. This wasn't a flaw in the system. It was a feature. A financial playbook that, once perfected by Nixon, became a permanent template, a blueprint for how a government eliminates its debt burden without the painful, politically unpopular act of actually paying it back. They proved they could inflate the debt away without anyone rioting in the streets. But that was when debt was 31% of GDP. Today, it's 123%. The old machine isn't enough. Now I'll show you the modern, upgraded system they've built and how it's already running at full speed. The machine is running right now. 56.4 trillion. That is the Congressional Budget Office's own projection for the United States national debt by 2034. Let that sink in for a moment. Not some fringe economic blog, but our government's official scorekeeper. They expect us to pile on another 20 trillion debt in less than a decade. You need to understand, this isn't just big numbers anymore. This is a mathematical impossibility. The machine is already running. Look at this chart. If our current average interest rate of 5% holds on that $56.4 trillion debt, we're staring down $2.8 trillion in annual interest payments by 2034. $2.8 trillion. Do you know what that means? It's more than our entire projected Social Security budget of $1.9 trillion. More than defense, more than Medicare. We would be spending more just to service the debt than we do to care for our seniors. This isn't just unsustainable, it's a national surrender. The numbers don't add up. Now, some critics, some academics, they'll tell you this is just prudent debt management, that governments always find a way. They'll argue that the sheer size of the U.S. economy can absorb it, that inflation is transitory, or that growth will magically outpace the borrowing. They are missing the point. The scale of this debt means the traditional rulebook is gone. The economic theories we learned in school are irrelevant in a 36 trillion debt environment. This isn't economics anymore. It's a desperate play for survival. And the Federal Reserve, their alleged independence, that's a polite fiction. When they recently signaled a definitive pivot towards accommodation, cutting rates by 50 basis points in an unusually aggressive move, the message couldn't have been clearer. Treasury funding needs have officially superseded inflation control. The Fed has surrendered. This isn't just about jobs, despite what Chairman Powell said. This is about making sure the government can keep borrowing at rates it can pretend to afford. It's what economists, those who dare to speak the truth, call modern monetary theory in practice, a supposed upgrade to financial repression, where the central bank simply accommodates unlimited government spending. The Fed is no longer fighting inflation, it is facilitating debt. So, how do they force this impossible math to work? How do they ensure the government keeps borrowing at rates that don't immediately collapse the federal budget? The answer lies in a set of obscure, technical banking regulations, rules that have trapped trillions of dollars in the system, forcing banks to fund the government's impossible debt at the expense of their customers. This is the machine. First, you have Basel III capital requirements. Sounds arcane, right? Here's what it really means. Banks are forced to hold government bonds as their safest Tier 1 capital. It creates a captive buyer for Treasury debt, regardless of the return they're getting. Your bank, the one holding your savings, is legally compelled to buy government bonds, even if those bonds are guaranteed to lose purchasing power due to inflation. They are a forced customer. Then there's the supplementary leverage ratio, or SLR. This regulation, temporarily waived during the pandemic and effectively made permanent for treasuries, allows banks to hold virtually unlimited government debt without triggering additional capital charges. Think about that. Banks can load up on government bonds without any real penalty to their capital ratios. It's an open invitation to buy. It's a direct subsidy from the regulatory state to the Treasury. And let's not forget the reverse repo facility at the New York Fed. This facility effectively absorbs over $500 billion in money market cash, keeping it from being deployed into the broader economy, where it might actually bid up Treasury yields. It acts as a pressure valve, controlling the supply of money and preventing the market from demanding higher interest rates for government borrowing. It's market manipulation by design. Each of these isn't an isolated policy. They are gears in a synchronized machine. They work in perfect harmony to funnel your savings, your bank's capital, and the entire financial system's liquidity into government debt, no matter how toxic the real return. They are repressing the financial markets. The enemy isn't just inflation, it's the architects of this system, designed to bail out an insolvent government on the backs of its citizens. This isn't just some theoretical risk of hyperinflation or a future bond strike. This is the reality we face today. The government's solution to its impossible math is to devalue the currency, to devalue your savings, and to make it virtually impossible for banks to do anything but finance Washington's runaway spending. The government isn't just looking for debt relief, they are creating debt servitude for the financial system. The winners and losers of this reset are already being decided. The government wins, big debtors win, and Wall Street wins. But who loses? Savers, retirees, you. In the final verdict, I'll resolve the mystery of the three-part machine and give you the personal escape plan. The verdict. Your financial escape plan. Verdict. The financial reset isn't coming, it's here. Look at this. Our national debt is screaming past $36 trillion, hitting 123% of GDP. The math simply doesn't add up. And when the math becomes impossible, the government doesn't change the math. They change the dollars. You need to understand this is not a conspiracy. It's a playbook, one they've used before, right after World War II. Our government, then faced with $269 billion in debt, 119% of our economy, didn't pay it back. By 1960, the debt was barely higher, at $286 billion. Yet the debt-to-GDP ratio had plummeted to 55%. They made the debt irrelevant. This wasn't magic. It was a ruthless strategy called financial repression. And the same three-part machine is grinding into action right now. The first part of this insidious machine, negative real interest rates. They suppress nominal interest rates below the actual rate of inflation. Think about the March 2022 moment. Real 10-year Treasury yields plunged to negative 4.8%. You bought a bond, thinking it was safe, maybe earning 1.15%. But inflation was raging. You were losing money. They lend you $1, you pay them back $1, but that dollar buys half of what it used to. This is how they systematically devalue their own colossal debt. It's an invisible tax on your savings. The second part is a limitless printing press. Remember August 15, 1971? President Nixon severed the dollar's link to gold at $35 per ounce. He removed the last constraint on unlimited dollar creation. The M2 money supply exploded from $15.5 trillion in February 2020 to $21.7 trillion by March 2022. That's a 40% increase in 2 years. This isn't stimulus, it's monetary fentanyl for a dying system. It inflates away the debt, but it also inflates away your purchasing power. And the third, most insidious part, regulatory capture. Rules like Basel III, enacted under the guise of financial stability, essentially force your bank, the supposed guardian of your money, to become a captive buyer for the government's toxic debt. New regulations make banks hold treasuries as Tier 1 capital. They don't want to, they have to. It's a rigged game. Your money, sitting in their vaults, is funneled directly to fund the very government that's devaluing your wealth. The Treasury's massive refunding needs this year are being met not by free markets, but by regulatory coercion. The Fed's independence, as we've discussed, lasts exactly as long as the debt stays manageable. At $36 trillion, it's no longer manageable. So, who are the losers in this engineered reset? Anyone holding cash, anyone with savings accounts, certificates of deposit, or government bonds. The 46 million American retirees relying on fixed income will see their living standards decline as their safe investments systematically lose purchasing power. There's $18 trillion sitting in savings accounts and money market funds right now, earning perhaps 4 to 5% nominal, while inflation claws away 3 to 4% or more day after day. You think you're safe. You're bleeding out slowly. The $10 trillion in US Treasury bonds held by the public at negative real rates represents $200 billion in real wealth loss annually. This isn't a theory, it's theft by spreadsheet. Now, the critics will argue this is just a necessary response to economic pressures, that the government is merely managing its finances responsibly. But look closer. When a government becomes this dependent on inflation and forced buyers, you risk a bond strike, where investors refuse to lend, or even hyperinflation, where the currency collapses entirely. These solutions are just desperate measures postponing the inevitable. But for every loser, there are winners. The government, obviously, gets to magically shrink its $13 trillion real debt burden over time. Debtors with fixed-rate loans, like mortgages or student loans, will find their payments easier to service as wages nominally inflate, but their payment amounts stay fixed. And the smart money, the owners of hard assets like real estate, gold, commodities, and productive businesses with low debt-to-equity ratios, these assets will see their nominal values rise with inflation. Think about it. A house bought in 2010 for $200,000, now worth $500,000? That's not pure growth. That's the devaluation of your dollar, captured in an asset they can't print. You could also consider Treasury inflation-protected securities for some defense, or even foreign real estate as a diversification away from the dollar's fate. They will pay you your interest, perhaps a nominal 5% on your bond or CD. But when the true rate of inflation is 8%, your real return is a guaranteed negative 3%. This is the invisible tax. It's the cost of being safe. Your safety, in this environment, is the government's profit. The math doesn't lie. You cannot save your way through this. You cannot bond your way through this. You must own things. Your goal is to get out of cash and bonds, out of their system, and into assets they can't devalue with a printing press or control through regulatory capture. This is the only financial escape plan. This is the end of the line for the US dollar as we know it. Don't forget to subscribe for more insights on how to protect your wealth during this crisis.